If you haven't already started to hear about it, you're more than likely going to start to see some of the headlines around the presidential election being the U.S. budget deficit. In this quarterly white paper, we're going to discuss why are we talking about the budget deficit now? Why is it becoming such a pressing issue? And then when you look at running such a big budget deficit, what does that mean from an economic standpoint and an investment standpoint? For many, many decades, the U.S. government has been able to issue treasury securities to fund our deficit, but they've been able to do it at very, very low interest costs. If you look at the 10 years leading up to the pandemic, the U.S. government was able to increase its treasury supply by $10 trillion, but only increase its net interest costs, or what it pays on those treasuries, by $190 billion. This is just one of the benefits that we had from the many decades of very low interest rates. And we know that that period is over. So what we're seeing is the budget deficit and the outlook for it getting much worse because not only are those net interest costs rising, but just the costs in general to fund our aging population are rising as well. There was a report released by the U.S. Congressional Budget Office where they talked about the outlook for our budget deficit. Not only are we running a $2 trillion budget deficit, but this budget deficit is expected to grow to about $2.8 trillion in the next 10 years. If you look at this chart, you can see that the deficit as a percent of GDP is expected to continue to accelerate over the next 10 years and be about 7% of GDP. When you go back in history, typically we run about a 3.5% to 4% budget deficit of percent of GDP. So this is unsustainable, and this is why this is getting talked about more now. From an economic perspective, being such an indebted country, it does give certain issues when it comes to stability. First of all, we've seen our credit rating downgraded already on 2 separate occasions because of our fights around the debt ceiling as well as the outlook for our budget deficit. But it also leaves very little wiggle room if there is an event of an economic collapse or a geopolitical event. There's just not much wiggle room to be able to increase spending when you don't have much excess savings there to do that, or you have to issue even more debt in order to do that. If you look at some of the past instances, whether it was our response after 9/11, where we were able to increase defense spending by over 50%, or if you look at what we were able to do after the global financial crisis in order to avoid a depressionary situation, and then look at the amount of money that we spent after COVID. All of these things happened, but we were running much lower budget deficits as a percent of GDP. And now, with our budget deficit as a percent of GDP and its outlook being unsustainable, it leaves very little wiggle room for an economy, not only to save if there's some sort of an event, but also being able to reinvest and invest in its own economy. So what does this mean from an investment standpoint? First of all, the bigger risk here is in our treasury market. We've discussed that. We've had our credit rating downgraded. Investors have really shrugged that off. We still have seen good demand in our auctions. But if you look at this chart, it's showing you that the treasury debt alone is expected to exceed 120% over the next 10 years. So there needs to be buyers for this amount of treasury supply. And what we've seen this year specifically is because interest rates are now above zero in many of the global economies, there's just not as much demand for treasuries alone as we used to see. Our auctions have been choppy. Some have been good, but some have been very poor. And we've seen the market react to that. We've seen interest rates move higher. When you have so much supply and the demand isn't always there on a consistent basis, we have seen yields move higher. So that is an impact that we see to long-term treasuries. We'd be very careful investing in super long-term treasuries at this point. And what that means for the equity market is the equity market doesn't necessarily like volatility in interest rates, especially some of those sectors like technology and those big growth sectors with high PEs. They don't like higher interest rates. And we've seen a very similar pattern throughout this year where bad auctions, higher treasury yields, and we've seen that impacted in some of those high growth and PE sectors. So there is investment implications to running such a big deficit, and it comes from higher interest rates and as well as the volatility there in some of those higher PE sectors. We aren't political experts by any means, but when you look at some of these numbers, it's clear to us that at some point this is going to have to be addressed through some form of austerity or spending cuts, or at some point tax increases. We know this isn't going to happen in a presidential election year, but this is something that is going to have to occur at some point in order for us to get this deficit under control. We simply, I believe, are kind of on borrowed time at this point. We've been able to fund our deficit and increase spending repeatedly because we've had low interest rates, because we've had buyers of our debt. But we're really walking a fine line here at putting the economy at risk, as well as what it may mean for investment portfolios. Now, we're watching our portfolios closely. Typically, the deficit isn't an investment theme that we would discuss, but we do think over the long run, we have to be very conscious of what this means for specifically longer-term fixed income, as well as some of the sectors in the equity market. So we're continuing to monitor this. We'll also continue to monitor over the next second half of this year of what the politicians may be saying on how they're going to get us out of this deficit, because we don't think that they're going to be able to avoid this forever. There needs to be some sort of a plan going forward in order to address this. That's all we have today. If you have any questions or comments, please feel free to reach out to your financial advisor. We also invite you to tune into our regular podcast, Markets with Megan, where we discuss up-to-date economic data and what it means to some of the regular market moves that we see. Thank you.